An unprecedented crunch could be happening in Canada. Roughly 60% of Canadian mortgages will renew by the end of 2026, and that alone could jack up monthly payments by double digits for millions of families. But at the same time, inflation isn't easing. December's CPI jumped to 2.4% year over year. You combine this stubborn inflation with a tsunami of mortgage renewals, and you have what could be a bit of a crisis brewing in real estate and household finances. December's inflation surprise in 2025's average CPI highlights why rates might stay high and why homeowners face a tough year ahead. We've already heard from most of the banks that they expect interest rates to stay high or even rise in 2026. StatsCan reports headline CPI up 2.4% in December versus 2.2% in November. Everything from restaurant meals to groceries spiked, thanks largely to a base effect from last winter's sales tax holiday. But if you exclude gas prices, inflation actually hit 3% in December. Core measures, which the Bank of Canada used, actually cooled, giving the BOC a little bit more room to sit on interest rates. But generally, the agreement is that if rates are going anywhere, they're staying flat or they're going up. On the annual outlook, inflation averaged just 2.1%, so the lowest since 2020. But that still leaves prices 19 or almost 20% higher than 5 years ago. Energy prices fell as the carbon tax was removed, even though we were told before it wasn't inflationary. Food and services costs kept rising throughout the year last year. Shelter costs climbed 3%, with mortgage interest and rent up both over 5%. And so with core inflation easing, analysts expect the Bank of Canada will hold rates steady throughout 2026. And Tiff Macklem even came out and said that he feels that this is about the right level to support growth while containing inflation. So restaurant prices jumped from 3.3%. Remember, the headline CPI jumped to 2.4%. But restaurant meals, I couldn't believe this. Restaurant meals were up over 8.5% year over year compared to just 3.3% in November. But the reality is it's a little bit of a misrepresentation in data, or just like a skew in data from the base effect, because we saw that big drop from the HST removal during the holiday. So in effect, last year's tax holiday dropped prices in the short term, but now those items sort of like fall off the comparison, pushing inflation back up. The same base effect hit other categories. Toys and games leapt, children's clothing, snacks, etc. I'm not sure if you remember, like during the holiday last year, it was like all these weird things that they got rid of HST on. And so the base-driven rebound froze out any disinflation from those categories. But at the same time, energy did the exact opposite. Gasoline dropped pretty substantially, 7.1% from November to December. So gas was actually pulling CPI down. But if you exclude gas, it was at 3.0% in December. And so headline inflation was higher, mainly due to last year's tax cuts effects. And if you look behind the headline, Canadians paid more for restaurant meals, coffee, and snacks, which is a big thing where Canadians actually, like where individuals, consumers will feel inflation the most. Inflation probably isn't out of control, but we're still at a point where consumers are very unhappy with the inflation situation, especially if the things that they consume the most, food being the big one, you'll hear people complain about food and grocery prices more than anything else. Now, the Bank of Canada's preferred measures, which is CPI median and CPI trim, actually edged lower, both at their weakest point since December 2025. And this would suggest that the underlying inflation pressures that the Bank of Canada pays the most attention to are actually easing. And economists would say that this deceleration should allow the Bank of Canada to keep rates on hold throughout 2026. Again, no mention of further cuts. As CIBC's Andrew Grantham noted, even though December's headline numbers surprised on the upside, the underlying inflation, your trim and core, is tracking near 2%. So he sees no change in the Bank of Canada overnight rate throughout 2026. Now, financial markets are already betting at this. After holding at 2.25% since last year, the Bank of Canada looks ready to keep the policy rate unchanged for a long pause. Tiff Macklem emphasized that he feels that we're at the right level. January monetary policy report, which comes out on the 28th, and hit subscribe if you want to see a video on that, because I'm going to be doing a full page turn on their monetary policy report. There's really no clear path for them to cut anytime soon. So those people expecting rate relief to resurrect the real estate market are probably not going to get what they're expecting. And the idea that interest rates are going to keep falling without a recession, which again, I could see a recession in the cards, where now that inflation is coming down, the next question becomes, are we going to see continued disinflation? Could we see deflation? Are we seeing demand destruction? And are we at risk of actually having 2 quarters of negative GDP growth in Canada's economy, plus rising unemployment? At that point, it might be time for the Bank of Canada to revisit and start talking about cuts. But that's 6 months away, or 3 months away at a minimum, because we'll have a negative quarter in Q4 of last year. Now, we talked about inflation. Now we want to consider the real estate side. So the Bank of Canada warned us that about 60% of all outstanding mortgages will renew by the end of this year. And this is a tidal wave. This is the most mortgages we've ever seen renew in one single year. Most of these homeowners locked in at very low rates in past years. At renewal, normal math says if rates don't fall, payments must rise. And the Bank of Canada's analysis shows that major hikes in payments are ahead for your average borrowers. Most monthly payments could be up about 10% higher, 6 to 10% higher compared to 2024 levels. Now, and the report finds that your 5-year fixed renewals could see 15 to 20% bigger payments. And this is like hundreds of dollars added to the monthly budget on top of all of the cumulative inflation that I just mentioned that we're seeing from Canada's Statistics Canada's reports. So overall, roughly 1/3 of all mortgage holders will face higher payments by 2026. So more Canadians, 1/3 of all Canadians mortgage Canadians will be paying hundreds more on their mortgages each month on average, even if the Bank of Canada doesn't hike further. And that stacks on top of that still high inflation that I just discussed. So for households already stretched thin, I think that this is huge. And this is why I don't think we're done with this sort of cycle yet, because we've seen what happens. We've seen rising delinquencies. We've seen rising unemployment. We've seen rising financial stress, right? House prices falling as a result of 2025's renewals and 2024's renewals. We're now going to get to the biggest chunk of that. And even though they're smaller, the jumps up in rates are smaller. It's the largest wave of renewals that we've seen. And it still takes time for those people to absorb the cost of their rates going up and their mortgage payment going up. Maybe, you budget it and your mortgage goes from $2,000 to $2,500 and you think you can get by, but then 6 or 8 months go by and you actually can't. And now you have to sell, and you sell quickly in a hurry, or you're going power of sale or whatever it is. This is why there's such a big lag with these impacts of the renewal wall of inflation being, their accumulation, right? It's a slow burn or slow bleed. Now, if we look at the annual review, the annual average CPI was just 2.1%, slowest since 2020. Do I think that the battle of against inflation is over? Probably yes. I think that usually when you win the battle against inflation, it's because you're creating a recessionary or deflationary or disinflationary environment, and that has a 100% success rate of getting inflation down. And I think that the Bank of Canada has done that. No metric in the economy would tell me otherwise right now. Now, the one clear story here is that services versus goods. Services inflation ran at 3.1%. This would include like dining out, rent, mortgage costs. Shelter inflation cooled to 3%, much lower than last year's 5.7%. This is something that I've been mentioning was going to move through the curve as we got past record high house prices, past the renewal wall, and saw the decreases in rent that we're seeing in the market materialize into CPI. And rent inflation actually eased to 5%, down from 8.2%, with Alberta leading the slowdown. Mortgage interest costs actually rose. And again, this is getting to that renewal wall, but nothing compared to the 20% inflation that we're seeing in mortgage interest costs in 2024. By contrast, goods inflation was running quite a bit lower. And so that's more your consumer stuff, which would indicate that maybe your consumer is running out of steam a little bit. Food, obviously, as I mentioned, is the big pain point. Canadians paid 3.5% more for groceries versus 2024. Coffee and meat, I've mentioned in a couple of other ones. Coffee was like 20% year over year. And I think meat was in the high teens. So, and again, these are just like things that are like, obviously the Bank of Canada can't control coffee prices, but these are things that people notice because they're buying coffee every day, or meat, they're buying meat. Beef was like 13.5%. You get a lot of stuff from fruit prices, retaliatory tariffs, et cetera. Anyway, to wrap it all up, on average in 2025, energy was a drag on inflation. Goods were fairly tame. Mortgage renewals aside, it's your food that is big, the real driver of increasing Canadians' cost of living. So overall, I would say December's CPI report and the 2025 annual review tell about the same story as the last couple. Inflation is moderating, but still above target, and it's sort of an uneven distribution. The big jump in December was largely a one-time base effect from that HST removal a year prior. And so the Bank of Canada is probably going to look through that But even in this new outlook, the Bank of Canada will likely keep the overnight rate at 2.25% in January. That's my guess, and focus on new data as it arrives. I'm interested to see their monetary policy report as it gets released on the 28th, and I'll make sure to cover that. So hit the subscribe button. For your everyday Canadians, like kind of beyond just the mortgage and the way the mortgage market is pricing this in, because again, we did see the a bit of a spike heading into the on the 5-year, but then it's sort of fallen off throughout the day. This tells us that the market had sort of priced it in. Like there, you're looking at basically like 1 basis point on this chart here, like really no movement on the Canada 5-year. We're probably going to stay in the rate channel that we're in. Mortgage rates will probably not go down. If anything, they're going to go up throughout the year. Still probably unlikely unless we see a ton of government spending. But I think the downside scenario, rates coming down, is probably more likely than the upside scenario, given just I think a recession is more likely than a return of inflation. So borrowing costs remain sort of like high in the short term, but I would say historically quite average. We're actually like basically right on your sort of long-term average interest rate, which is like 4.11%, I want to say, from a mortgage perspective. And so my guess is that inflation will continue to fall slowly as consumers keep feeling the pinch, as their mortgages go up, as their cost of living, gradually eases up. And so if inflation stays above that 2%, the bank might keep rates tight. There's probably not a lot more relief they can give to the market in regards to cutting rates further. But if they cut rates too soon, they're probably afraid that inflation could creep back up. And I think Canadians have proven to be pretty irresponsible when it comes to the pivot paradox. If they think the Bank of Canada is going to cut, they'll go and front run the market and try and load up assets, and things get inflationary pretty quickly. And so, they say, oh, we've beat inflation, let's drop rates. And if consumers see that and they think that that's the case, then they start making irresponsible financial decisions, and it kind of negates the impact of the cut. Anyway, thanks a lot for watching this analysis. For more insights on inflation, which I cover every month when it comes out, obviously the real estate market, mortgages, housing policy, hit the subscribe button, join my community link below, where I have a weekly call called the Realist Roundtable, where I talk to investors and people in the housing industry on Mondays every single week. One of those calls per month is totally free. And let me leave you with a question, as I always like to. Do you think that the Bank of Canada should hold rates steady or cut them to ease pressure on homeowners? And I guess, sort of embedded in that question is like, what do you think is a more likely outcome that we'll see in 2026? Are we going to see a return of inflation, or are we going to see a recession? I'm on the recession team, and I think recession means deflation, but I'm curious to get your thoughts. And I try my best to respond and read all of the comments. So let me know what you think. And as always, I appreciate you taking the time out of your day to watch this video. I'll see you again as soon as I can.